Have you ever wondered why banks win when scalping but retail traders keep losing? It's because banks use advanced strategies to execute hundreds of trades per second, while most traders get stopped out chasing bad entries. Just last week, I made 53k trading the 1 minute time frame. Today, we took home $53,000, 53.4k. And in this video, I'm revealing my best kept scalping secrets so you can stop losing and start winning. Secret number 1 is timing. The Forex market is open 24 hours a day, but not all hours offer the same trading opportunities. Ideally, you want to be scalping during the peak hours when the market is moving the most, because that's when the real money is made. More volume, more volatility, and way more trading opportunities. Now let me show you a quick example. Look at EURUSD here. During the Asian session, price is just bouncing around in a tight little range just like this, consolidating. We can see that there is no real direction whatsoever, no clear buyers. So let's say you try to trade the breakout of this consolidation, right? You draw a box right here and you say to yourself, you want to enter for a sell once price break out of this box to the downside. And then price eventually break out of the box to the downside. This is where you start entering for a sell, right? And then you place your stop loss maybe above or rather in the middle of the box itself. Next thing you know, price actually went back up and stopped you out and just continue in this consolidation, continue going sideways. Now, you say that, you know what, I'm going to enter for a buy once price breaks out of the consolidation. And I'm going to place my stop loss once again in the middle of the box, right? Let's see whether it actually works or not. Boom, we are in profit. We are buying the Ferrari real quick. Bam, bam, there goes your dream of driving your dream car. There we go. Now, let's look at EURUSD again, but this time during the New York session. Same currency pair, different timing. And this is where the big players actually step into the market. So right here we saw that this is actually the last lower high that led to this internal break of structure, which means that if price take out this high right here, we will have a market shift, which confirmed to us as a shift in structure and price is reversing and it's gonna head up right now. So that is where after price actually create the market shift, we waited for price to pull back to this flip zone that we have right here. And let's say we make our entry at this flip zone itself, right? So by now we are already tapped into the trade, and look at what happened next. Boom, there you go, there you go. That's the magic. This is exactly why timing is everything. You want to ensure that you are trading at the right time, because scalping is all about speed and momentum, which is why the first scalping secret is you want to be trading during the active hours, the best times to actually scan for trading opportunities. Before I talk about when to trade, let me tell you when not to trade. You shouldn't be trading during inactive hours, because if you're trading during inactive hours, you are going to get low liquidity, which means orders don't get filled properly. You're going to get wider spreads, which means you are paying more commission and losing extra pips just to get in the trade. And you're also going to get slow price action, which means there's not going to be much momentum, and that means no clean move, no Ferrari. Simply put, you're just wasting time watching price barely move, dealing with unnecessary spreads, and forcing trades that just aren't there. Right, so inactive hours are basically post-London open from 10 AM to 12 PM UTC, and New York close 8 PM to 11 PM UTC, and Asian session 2 AM to 5 AM UTC. Now, there's an exception to Asian session though. Now, in my opinion, I think you should avoid scalping during the Asian session, unless you are specifically trading the Japanese yen pairs, like USD JPY, GP JPY, Euro JPY. Because liquidity is lower during the Asian session compared to the London and New York session, which means once again slower price movements and wider spreads. Now with that said, the Asian session can actually be suitable for beginners who actually prefer the slow price action, because lower volatility makes price action more stable and easier to analyze. Which is why if you are still a noob learning how to read the charts, this session can provide a less stressful environment before you start to transition into more volatile sessions like the London and the New York session. Now for majority of the scalpers out there, you want to be sticking to sessions where big players are active, because this is where you're gonna have a much more easier time catching solid setups. And that is our active hours. So during the active hours, that is where you can have more liquidity, which means tighter spreads. because the big players are literally active, right? They are trading, which means faster execution, lesser slippage, and lower trading costs. And during the active hours, there's going to be much more stronger trends and breakouts because we're going to have higher volatility, which means the move is going to be a lot more clean and it's much more easier to catch profitable trades without getting stuck in the choppy, ugly price action that we got during the inactive hours. And this translates to better risk-to-reward opportunities because during the peak hours, this is where price follow through, more reliability, allowing for tighter stop loss and higher risk to reward. So with that said, these are the active hours that you should be actively scalping. First of all, the London Open is around 8 AM to 10 AM UTC. This is where there's gonna be a massive amount of liquidity stepping into the market because that's where banks actually start trading. And then there's also the New York Open. This is where there's gonna be huge volume as Wall Street opens. And then there's my favorite, the London New York overlap. This is the most volatile part of the day itself, right? And it's my favorite because that is where you can catch like insane move just like this. Remember, at the end of the day, we need big institutions, hedge funds, and market makers to be active in the market because their money is what moves price. Without them, you're just gambling in the slow-moving markets. Before we move on to secret number 2, here's a very powerful scalping strategy that you can use, and it's called the Asia sweep strategy. The first step is to identify the consolidation that the market is in during the Asian session. This way, you are able to identify the highest point of the consolidation and the lowest point of the consolidation. And then based on that, you can mark up your Asia high and you can mark up your Asia low. Just as the name suggests, we are waiting for either the high or the low to be swept before we look for our entry. The second step is to wait for the London session to open. 30 minutes before the London session open, this is where you can actively start looking at the market and wait for price to actually take out the Asia low or the Asia high. So let's see what happens next. In this case, price actually come down here and take out the Asia low. As you can see right here, by this big bearish candlestick, what this indicates is that liquidity has actually entered into the market, or rather smart money has actually started trading. And the first thing they did is to take out all the retail traders who placed their stop loss below this low, sweeping the Asia low. This is where we know that the real move is about to happen. And that is where you want to wait for further confirmation to show you that sharp V-shaped reaction. So once the Asia low has been swept, this is where you can start looking for buys, right? Because we know that right now, price is about to go up now after we managed to grab all the available liquidity below this low right here. So let's say I enter for a buy right here, place my stop loss below the liquidity sweep and place my take profit at about 3R just like this. Very, very simple. And boom, there you have it. Asia sweep strategy. Now, if you miss this entry, don't worry because there's actually a second entry opportunity, and that is when price actually pull back to this liquidity sweep area, right? So this is the zone, this is the demand zone that swept liquidity, making this a sweep zone. So what we can do is to wait for price to pull back to this sweep zone as well, and then look for our entry from there. And then once again, the same philosophy. Right there, you can tap into the trade and boom, 1:3, as simple as that. Now, this strategy is very, very simple. All we are doing is to wait for the smart money to actually enter into the market, and then once they do, we just follow behind and just ride the big money. And the reason the Asia sweep strategy works so well is because of market psychology. During the Asian session, we know that activity is slower, right? There's not much trading activity, so price tend to stay in a range. But as soon as the London session kicks off, liquidity spikes and the bigger players start to push the price. And this gives us the perfect opportunity to jump in and capture quick profits just like this as the market sweep through the Asia low or Asia high. Now, the key to this strategy is timing. You don't want to be entering too early, you don't want to be entering too late. You want to time your entry perfectly right after the Asian consolidation ends, during the London session opens, after price swept either the Asia low or the Asia high. That's when the market's liquidity and momentum give you the best chance to make your move. Secret number 2 is execution. When you are scalping, you want to ensure that you are using the right time frames to analyze and execute your trades. Most retail traders, they make the mistake of jumping straight into the 1 minute or the 5 minute charts without considering the big picture. When you do this, you are scalping without context because you'll be trading based on all these short-term fluctuations that might not be aligned with the bigger market trend. And this can lead to you getting caught in false breakouts or trading in the opposite direction of the market's true momentum. So instead of mindlessly jumping straight to the lower time frames, here's a much better and more profitable strategy. It's called top-down analysis, which states that you should always begin by analyzing the charts on the higher time frame. So if I'm scalping today, I'm always going to start off by analyzing my 15-minute chart. This is where I will look at the overall trend direction, and I'll map out my swing structure and also my point of interest, right? So using this chart example right here, I saw that this is our break of structure to the downside, right? So when price actually created this bearish break of structure to the downside, we know that this is our last 15-minute swing high, and then this is my 15-minute swing low that we have right here. So right now, just by doing this alone, we narrow our focus to this tight range right here, rather than whatever price is doing over the past few weeks or so. Now, next, you want to actually map out your point of interest, your supply and demand zones, your order blocks, your flip zones, whatever it is. So in this case, I draw that this is actually my extreme supply zone, and then I can also see another order block right here. And then there's one more supply zone right here that swept liquidity from this high right here. Now, just by doing this alone, this gives you a sense of where to focus your efforts on the smaller time frame, which means if price is like in the middle of nowhere just like this, you shouldn't be going down to the lower time frames whatsoever. You should only zoom into the lower time frames once price actually enter either one of these point of interest that we have right here. So for simplicity's sake, I'm only going to be focusing on the extreme point of interest that we have right here, which means until price get to that area, I'm not going to be doing anything whatsoever, right? You can see here, price starts turning bullish. Why did price start turning bullish? You must understand what is price trying to do. It's actually just facilitating that pullback so that price can actually create a new lower high for price to continue in the higher time frame bearish order flow. So in this case right here, you can see that price has actually mitigated our 15-minute supply zone. And if you were to refine this zone to like a 5-minute supply zone, you can see you also tap into the 5-minute extreme supply zone, right? It's really like the last line of defense. And you can also see that price swept the available liquidity above this high as well. So when that happened, I got my entry confirmation, and that is where I can potentially look for my sell position right here. And I'll place my stop loss above these highs. And you can see, by doing this, I'm trading in sync with my higher time frame order flow. Because right now, the internal structure is about to shift bearish to trade in continuation with the higher time frame structure. And this improves the chance of my success. So just by doing this, you can see we got tap into the trade right there. Once you got tap into the trade, just hope and pray for the best. And as usual, it is what it is. As you can see, this is a very clean entry, but what you can also do is to jump into the 1-minute time frame, the minute price actually tap into your 15-minute supply zone, right? And this is where you can look for further confirmation, right? So let's say you want to wait for a price to create a market shift. Okay, cool. We got a market shift right here, and then you waited for price to actually create the flip zone right here, and then you entered after the flip zone. So you entered somewhere right around here for a sell after price mitigate the flip zone, and you place your stop above the flip zone just like this. In that case, it works as well, right? Because at the end of the day, you are waiting for price to mitigate your higher time frame zone, and then once it does, you drop down to your lower time frame to look for your entry, because this way you can have a much tighter stop loss, much better entry, and a much higher risk to reward ratio. And this is really how I catch those sniper entries. Secret number 3 is priority. When you are scalping, you want to be entering at high probability zones, not just any random supply and demand zones that you see on the charts. When I made 53k on this one trade, I didn't wait for any confirmation before pulling the trigger. I jumped in right after price hit my point of interest. Now you might be wondering, why the hell would you do that, Brad? Why would you risk $10,000 on a trade without confirmation? No market shift, no doji candlestick pattern, nothing usual that gave me the typical confluence signal. Here's the thing, it's because I understood that the zone that I was trading was a high probability area. I've been around long enough to recognize that even without all the extra signals, this zone has a very high chance of working out. The key is knowing when a setup is solid, that the odds are in your favor, and that confidence comes from experience. I knew the price action was lining up and I trusted my ability to execute quickly and effectively. Now listen, trading is a probability game where every trade has a chance of success or failure. When you identify a high probability zone, you are essentially identifying a point in the market where the odds are more in your favor based on technical analysis, patterns, and historical data. It does not mean that it will 100% work, but it increases the likelihood that price will react in your favor. So let's look at the confluences that made this zone a high probability zone. Firstly is market structure. If you look at the swing structure right here, we saw that this is that last 15-minute swing low. Right, so we know that this is the last 15-minute swing low and it's really that last line of defense for price to stay bullish. Since this is that make or break point, it's much more high probability for you to actually enter for a buy right here to trade in alignment with that higher time frame trend. Because if price actually come down here and take out this low, what happens is that the higher time frame trend is about to shift bearish. Now the second confluence was order block. Right, if you look at this zone right here, it's not just an ordinary demand zone. What do we have right here? We got a ton of imbalance in price. This indicates that smart money, institutions, whatever like to call them, have entered for a large amount of buy orders at this price point itself. So we know that when price come down to this order block, there's gonna be more demand stepping into the market, right? Because there's some orders yet to be filled. The third confluence is liquidity sweep. If you look at this zone right here, it swept the liquidity from these swing lows that we have right here on the left hand side. When this happens, this just means that the big players have successfully hunted the stop loss of retail traders right here and created liquidity to fuel this huge move to the upside, making this a sweep zone. And last but not least, this is also a flip zone, right? If you look at this zone right here, what happened was that price actually mitigated this supply zone, okay? It mitigated this supply zone. And if this supply zone were to do its job, guess what? Supply will step into the market and cause price to go down and take out this low. Continue this lower low, lower high dynamic. But that actually did not happen. It created a failed reaction when price failed to take out this low, which tells us that at this price point, supply has officially flipped to demand, giving us a flip zone. Now, on top of being a flip zone, it is also an institutional demand zone because it led to a break of structure to the upside that we have right here. So yeah, after I entered at this ultra high probability zone, as you can see right here, price just went up immediately. It did not even dip into the drawdown. It was one of those perfect sniper entries where the timing couldn't get any more better than that. And what made this entry even more powerful was that I actually entered the trade during the London and the New York session overlap, which I mentioned just now is the sweet spot for volatility and liquidity. Now, here's the most important thing about this secret. The more confluence a zone has, the higher the odds of the zone actually working. So if you spot a liquidity zone at a market structure level and there's an order block and a flip zone lining up all at the same spots, you have a much higher chance of success. And you gotta grab it. Because this is exactly what I did. I had all the confluences in the world for me to actually deploy my risk entry without waiting for further confirmation at this price point. Now, secret number 4 is management. In scalping, entry is just half the battle. Exiting the trade at the right time is just as important as entering at the right time if you want to become a profitable trader. Because if you exit way too early, you risk leaving money on the table, potentially missing out on a larger move. But if you exit way too late, you risk giving back all the profits that you have made back to the market or even ending up with a loss. To avoid falling into the trap of greed and emotional decision making, you need to ensure that you have clear mechanical exit rules before you even place a trade. By having mechanical rules in place, you give yourself the best chance for consistent success, because consistent actions leads to consistent profits. For example, if I'm scalping, I usually place my take profit at the nearest 5-minute swing high or low, or the nearest 5-minute point of interest, because I like to be pessimistic when it comes to my profit targets. I never ever assume that price will actually break past the next 15-minute structure, because honest to God, the last thing I want is for price to be a few centimeters away from my take profit and then start reversing against me. Now, when it comes to stop loss, I always place it above or below the point of interest that I actually enter the trade on. So if I'm entering at this demand zone, my stop loss is a few pips below the demand zone. If I'm entering at this supply zone right here for a sell, my stop loss is a few pips above the supply zone. And I have a rule that says that my stop loss must be at least 2 pips minimum. This allows for some breathing room, especially considering the spread. Because if your stop loss is set way too close to your entry point, the spread could easily trigger your stop loss before the market even moves in your favor. So give your stop loss at least 2 pips. Now on this trade right here, even though I entered on the 1 minute time frame, it took me about 2 hours to actually hit take profit, which makes this an intraday trade. So if I was scalping, right, and I was using those rules that I explained to you just now, what I'll personally do is that I will enter right here, same thing, my entry will never change, but my stop loss will be below this zone, right, which is actually the same thing. But here's the difference, it's my take profit. I'll be placing my take profit at the nearest 5-minute swing high. So if I look at the nearest 5-minute swing high, I know that it'll be this high right here, right? This one right here, this will be my nearest 5-minute swing high right here. Okay, so this is where I'll potentially place my take profit at this supply zone right here, at the edge of the zone, just like this. Right, quick little 1:3 scalp, in and out within 30 minutes or so. Once again, look at my stop loss. My stop loss is not like down here. No. I give it a little bit of breathing room below the point of interest, in the case that price could potentially make a little pullback before price actually go in my way. Right, and once you set your stop loss, once you set your take profit, it's time to just set and forget. Just trust your analysis, let the trade play out, let the market do its thing, because now it's outside of your control. So yeah, please, for the love of God, keep on micromanaging your stop loss and take profit, because when you do that, you allow your emotions to take over. And next thing you know, you are extremely inconsistent in the way that you actually manage your trades. And this causes you to get inconsistent profits, obviously. So yeah, I'm sure you heard it 1,000 times by now, but stick to your plan, trust your analysis, and exit when your strategy tells you to. Because consistency comes from discipline, not from chasing bigger profits during the trade. Secret number 5 is mastery. If you want to get really good at scalping, you want to become the master of one pair, rather than a jack of all pairs and master of none. I know that when you look at trading videos on YouTube, you will see most of these YouTubers have like 10,000 different currency pairs on their watch list. But just because they do it doesn't mean that you need to do it as well. In trading, it's easy to get caught up in the idea of needing to know everything or track every currency pair or jump between stock market to crypto or futures one day. But here's the thing, mastering one currency pair will give you far more edge than spreading yourself way too thin across a dozen currency pairs. Think about it this way, when you focus on just one pair, you can dive deep into its behavior, its patterns, its rhythms, and its unique traits. You start to understand how it moves during different times of the day, what news affect it the most, and even its response to global economic events. And this allows you to trade with precision because you have a very deep understanding of the currency pair that you are trading. And that's hard to achieve if you're just constantly switching between different pairs every single goddamn day. Just like what my man Bruce Lee said, I fear not the man who has practiced 10,000 kicks once, but I fear the man who has practiced one kick 10,000 times. Ooh, that's deep. So with that said, let me just quickly run you through the characteristics and traits of my favorite scalping instruments. Yeah, like I said it, these are like generally my favorite pairs when it comes to scalping. So first of all, gold. Gold is volatile during Asian, London, and New York session, and it follows price action surprisingly well, right? It's actually very, very smooth. But with that said, you also get these super large price swings where price can go up, down 100 pips within 30 minutes during the New York session, and is heavily affected by news events, especially those that is related to the US dollar. Next is EURUSD, right? We all know EURUSD is volatile during London and New York session. It has very tight spreads, which makes it very, very good for scalping, and it follows price action well, and is extremely good for Asian sweep strategy, the strategy that I talked to you about just now. Next, we got NASDAQ, or indices as a whole, like US 30, NQ, etc. This is more volatile during New York session because after all, it's literally a basket of stocks, right? And it moved very, very aggressively. You can expect sudden and sharp move in one direction. Like when price goes up, it just goes up for like hours or sometimes even days. And when it goes down, it just goes down. And then we got JPY, which in my opinion, it's like a baby between Nasdaq and gold, right? Because it's actually volatile during the Asian session, and it has this, it's just very fickle, right? It's that baby who just like to throw tantrums. It's strong and it has these wide price swings, right? Like when price goes up, it just goes up, and when price goes down, it just goes down. When it rains, it pours. That quote describes JPY. And it actually follows the trend quite well, right? Like I said, when it rains, it pours. When it goes up, it can go up like very, very fast. When it goes down very, very fast as well. And one thing that I don't really like is the fact that it has wide spreads. So yeah, with that said, just understand that in trading, it's not about knowing every possible setup or strategy for every currency pair. It's about mastering one. When you dedicated yourself to truly understanding one currency pair inside and out, you master it and it becomes second nature because you have practiced that one kick over and over again. And when the moment comes, you can execute it perfectly every single time, just like the Karate Kid. So that's the 5 scalping secrets that the banks don't want you to know. Now, it's one thing to actually watch the video and actually learn the concepts, but it's another thing to actually apply it. Trust me, it's application of these concepts that will actually make you money. So go out there, backtest the strategies, test out the timings, and just go do whatever you can to make your first 10K a month. Now, speaking of making 10K a month, I've created a 10-hour free course. You heard that right. There's never been a trading course on YouTube that is 10 hours long. And I'm gonna give it to you for completely free. You can check it out right here. So yeah, click on this video. I put in so much goddamn effort. Like, I swear to God, you have absolutely no idea. It took me months to actually create this video. This 10-hour long free course. So you better go and watch it. If not, subscribe. Bye.